Today is July 21, 2026, and the signal in today's market is less about momentum and more about institutional positioning. Across both XRP and HBAR, the theme is the same. Regulated infrastructure continues to attract measured but persistent attention. On the XRP side, one of the clearest developments is the continued flow into spot altcoin ETFs, with XRP accounting for a meaningful share of those modest inflows. That matters because it shows where cautious institutional demand is concentrating when capital is selective. These are not headline-grabbing flows, but they are consistent with a market that is still testing exposure to digital assets through more familiar wrappers. For XRP, that reinforces its core narrative, a network designed around payments, liquidity, and settlement use cases that are legible to institutions. Another important story is the expansion of tokenized US Treasuries on the XRP Ledger, which have reportedly surged eightfold over the past year. That is a significant data point. Tokenized treasuries are becoming one of the most practical early use cases for on-chain finance because they connect traditional cash management with blockchain-based settlement rails. For XRP Ledger, the implication is straightforward. This is not just about speculation around the token itself. It is about whether the underlying network can support real financial instruments, real counterparties, and real compliance expectations at scale. There is also a broader market context here. XRP has been moving unevenly relative to the rest of crypto, but that kind of underperformance is not unusual when markets are rotating between narrative and utility. The institutional story tends to build slowly. It is shaped by product access, treasury use cases, and infrastructure adoption rather than by short-term price action. Turning to Hedera, the institutional angle is equally clear. A recent custody upgrade is important because custody remains one of the most sensitive requirements for enterprise adoption. Large firms, funds, and regulated entities do not simply need a fast network, they need secure operational controls, compliant storage, and institutional-grade access. A custody enhancement may not capture retail attention, but it is exactly the kind of plumbing that can support broader enterprise participation over time. Hedera is also drawing notice from policy and public sector commentary, including a UK government report that highlighted its role in tokenization. That is notable because tokenization is increasingly where blockchain networks are being evaluated on practical business grounds: asset issuance, record-keeping, settlement efficiency, and auditability. Hedera's design has long emphasized governance, predictable performance, and enterprise alignment, and that continues to position it in conversations about regulated digital infrastructure. Then there is the Bills on-Chain pilot, which recorded 830,000 transfers in 2 weeks. That is a useful operational signal. High transfer counts in a pilot environment suggest the network is being tested in conditions that resemble real workflow volume, not just theoretical throughput. For institutions, that kind of evidence matters, because adoption often starts with narrow pilots and only later expands into production systems. Taken together, today's news shows the same broader pattern across both networks. Institutions are not chasing headlines, they are exploring infrastructure. Whether through ETF access, tokenized treasuries, custody, or government recognition, the market is still building the rails for regulated digital finance. That is the story to watch. XRP and HBAR are both being evaluated less as tradable assets and more as pieces of financial infrastructure. That distinction matters, and it is where the long-term narrative is being formed. Not financial advice, educational content only.